silver's going to 50, 70, 100, soon. And that's a big deal. And yes, I agree with you. I think psychologically, up until now, what people have been kind of saying is, well, the gold market's a bubble, and a lot of the analysts in Toronto who are following these mining stocks saying, oh, yeah, it broke through 2070 to 2300, but it's coming back down to 2000. They had all their models built on 2000. Well, yeah, it made it to 2800, but it's still coming back down to 25. Well, yeah, it made it to 3,200, but it's coming back down to 3. Well, yeah, it made it 34. Pretty soon they're going to say, holy shit, there's something bigger going on here. This is not coming back down. We're not going from 3,400 to 3,000. We're going from 3,400 to 4 to 5 to 6 to 7, Now, which is not to say there won't be corrections along the way. Could we go from 3,400 to 3,000? Absolutely. We could go back to 2,800, but I don't think we'll go below that.
The silver market remains resilient, even after a modest pullback in early Friday trading. The $37.50 level has repeatedly acted as a critical pivot, first as resistance, then as support, and it remains the line to watch. If prices retest that zone, traders may try to press lower, but silver has consistently bounced back, quickly regaining ground toward $39. A clean break above $39 would set the stage for a run at $40, and if that barrier falls, the upside potential broadens significantly. In this environment, veteran investment manager Lawrence Lepard sees silver confirming gold's breakout. For him, the technical action in silver isn't just noise, it's evidence that the broader precious metals bull market is alive and gaining strength. He points to recent discussions, including an interview with Gary Savage, that echo his conviction. Silver's performance is reinforcing the larger trend already unfolding in gold. For years, every step higher in gold has been met with doubt. Analysts repeatedly called for pullbacks after each milestone, arguing that the rally couldn't last. But the narrative may be shifting. The move from $2,000 to $3,000 in gold took nearly 2 years. According to Lepard, the climb from $3,000 to $4,000 could happen in half that time. Major banks are starting to agree. Goldman Sachs and JP Morgan now forecast gold reaching $4,000 by mid-2026, only about 15 months after the March 2025 breakout above $3,000. That accelerated timeline, combined with silver's technical setup, points to a new phase for the sector. What Lepard sees is simple. Precious metals aren't just holding steady, they're preparing for their most powerful move yet. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
The fact that silver is now starting to confirm the move in gold, gold moved first and silver's following through, that's huge. I am so bulled up on silver right now, Tom. As I told you, I listened to your interview earlier, with Gary Savage, and silver's going to 50, 70, 100, soon, and that's a big deal. And yes, I agree with you. I think psychologically, up until now, what people have been kind of saying is, well, the gold market's a bubble, and a lot of the analysts in Toronto who are following these mining stocks saying, oh, yeah, it broke through 2070 to 2300, but it's coming back down to 2000. They had all their models built on 2000. Well, yeah, it made it to 2800, but it's still coming back down to 25. Well, yeah, it made it to 3200, but it's coming back down to 3. Well, yeah, it made it 34. Pretty soon they're going to say, holy shit, there's something bigger going on here. This is not coming back down. We're not going from 3,400 to 3,000. We're going from 3,400 to 4 to 5 to 6 to 7, Now, which is not to say there won't be corrections along the way. Could we go from 3,400 to 3,000? Absolutely. We could go back to 2,800, but I don't think we'll go below that. But in a seesaw fashion, gold, all bull markets try and shake off as many riders as possible. So most people should be aware about the time they feel like they got to own it. Well, then there's going to be a correction. But, if you take a long view on this, I think we're going much higher in both of these. I think that's right. I think, I hesitate to say it's different this time, but I think there are fundamental underlying drivers here that you need to understand to recognize that this is going to go further than people think. And it's been a long time coming. And by the way, some of these charts are just absolute things of beauty. You look at the silver chart, it's just a long rounded bottom with a cup and a handle and now a breakout. And $100 is like falling off a log. It could go to much higher than that. So, and by the way, most of the companies I own that mine silver, the cost to mine was $20, $25 an ounce. $32, they were kind of getting by. at $100, they're going to be making some profit. I mean, to tell you, right? I mean, it's going to be, their costs will go up, by the way, because there's inflation on all their inputs. But they're not going to have inflation of 500%. They're going to have, or of 100%. They're going to have modest inflation, and the price of the metal they're selling is going to go up, 2x or 3x. So, there was a bull market from 2001 to 11. And then there was the bear market, and then there's the bull market that started kind of in 2016, and we're in it still. And what you can see back in the one from 2001 to 2011 is that gold went up, but the stocks went up even more. And that's because they represent streams of gold, and gold just sits in a vault and doesn't reproduce. What you can see from the bottom in 16 to the present is that gold has gone up quite a bit. And the stocks, the response of the stocks has been quite muted. They've underperformed gold in terms of appreciation. And so there's a big kind of alligator jaw difference between the price of gold, which is at 3,400, and the Huey, which is at 400-ish. And so my expectation is that as people come to realize that prices are going to go much higher in the gold market, these stocks are going to catch up. And the stocks are still looking in the rearview mirror thinking, oh, this gold price isn't going to last. But once they realize it's not only going to last, but it's going to go to 5,000, there's going to be just a very aggressive and massive move in these stocks. And so I am really, really bulled up. My fund is probably up to 70% so year to date. But honestly, from where it is right now, I sincerely believe it could double in the next 12 to 18 months. I think it will. Mm-hmm. And that's just because of the catch up. These gold and silver stocks have really lagged the underlying movement in the price of the metal. And I'll tell you one of the reasons for that, I mentioned this before, is that this used to be the only way to play alpha on monetary debasement was gold stocks. Gold would go up and the stocks would go up more. So everyone wanted to make more than just the price of gold going up. They buy gold stocks. Well, that's not really the case anymore because Bitcoin exists. So if you look at gold stock investors, they're generally over 40 or 50 years old. And so all the young people, they're not buying gold stocks. They're like, screw that shit. I'll just buy Bitcoin. I understand that argument, but it means that there's less interest in these things than there used to be. But all the same, I mean, the big pools of money, I mean, right now, the entire gold stock market is about $500 billion, in the context of a stock market of closer to $50 billion or $50 trillion of value. So, it's like 1% of the total value of all the stocks outstanding. And so, what's going to happen here? I mean, these people, these algorithmic traders, these algorithmic managers and others, they're going to look at like my report and they say, hang on a second. You mean to tell me the S&P went up 6% and gold stocks went up 50% in the first half of the year? Shit. Why don't I have any of those? Mm-hmm. I mean, and that doesn't mean they're going to sell all the S&P and go buy gold stocks, but it means they're going to go from a 0% allocation of gold stocks to a 4% allocation. And, that 4% is not a small amount of money, given how small the market for gold stocks is, if you see what I'm saying.
The idea of a gold reset has circulated in financial circles for decades. Still, Lawrence Lepard argues that it would require a dramatic revaluation to have a significant impact on the U.S. Treasury. In his view, gold would need to be marked up to somewhere between $10,000 and $20,000 per ounce to repair the balance sheet truly. That kind of step, he says, would only be politically viable in the wake of extreme inflation, when public pressure to fix the monetary system becomes too strong to ignore. While he doesn't expect it in the near term, Lepard sees it as a plausible outcome under the right economic strain. His longer-term outlook for gold between 2030 and 2050 spans a wide range of scenarios. From $10,000 per ounce to gold-sharing reserve currency status with Bitcoin, and even the extreme possibility of global supplies being exhausted by mid-century if relentless demand outpaces production. For now, China and broader Asia remain the strongest engines of physical buying, underpinned by cultural ties to gold as a store of wealth. In contrast, U.S. demand has been relatively subdued, with ETF flows also quiet. That said, there are hints of revival, from Costco selling out of gold bars to an increase in inquiries from retail investors. On the market side, July was steady. The Shanghai Gold Exchange reported a seasonal rebound in withdrawals, although they remain below long-term averages. Meanwhile, the Shanghai Futures Exchange saw activity cool from earlier peaks, but remained at historically elevated levels. Looking ahead, Lepard expects a seasonal improvement in China's wholesale demand, especially for jewelry, although affordability challenges may limit volumes. Let's get back to the interview.
Well, the whole issue of gold revaluation is a fascinating one. I mean, Miran wrote a paper about this. Trump has said things like he who has the gold makes the rules. Besant has said things like, we need a new Bretton Woods agreement, which is the last one, and I want to be at the table when it occurs. Besant has said things like we have assets that we could sell and revalue, which, I view as being the gold, even though he denies it. I'm sure it is. It appears to me that gold revaluation is kind of on the table and part of the discussion. I think the administration understands that we need a neutral reserve currency and that the system we've got has hollowed out our manufacturing base. And where that's become particularly acute is in these wars and how quickly we're burning through munitions and we can't replace them. And now, of course, we've all read the stories about how we need all these rare earths that only China produces. And so we're going to put tariffs on China, and China's like, yeah, that's fine. We're not going to sell you any rare earths. Ford's like, hang on a second, I need those to build my trucks. And China's like, well, all right, we'll let you have them for the trucks, but we're not selling the rare earths that you guys are using in weapons. And so, the Pentagon, the CIA, the administration, I think really understands the dilemma we've gotten ourselves into, and that we've got to return to a neutral reserve currency. And I'm sure they've had conversations about a reset of gold and maybe about a reset surrounding Bitcoin. But, whether or not they've got the courage or they feel like there's the political space in which to do it, I mean, sadly, I think it's probably pretty thin. I think, I don't know though. I mean, Trump is bold and he's done bold things so far, and maybe he'll do a bold thing like a gold reset. I mean, the problem is, the gold's carried in the $40 an ounce range, today, and if they reset it to today's market, it add like $1.5 billion or $1.5 trillion to the TGA. That's just not that much. I mean, to really make it work, they'd have to go to 10 or 20,000 an ounce or higher. And whether they're going to do that or not, who the hell knows? I mean, obviously, if they do, those of us who've invested in the metal, invested in the mining companies, we're going to be, silly rich. Of course, they probably put in a huge tax rate on that kind of stuff. But anyway, it's a different matter. But the gold reset thesis is interesting because if you read the tea leaves around the discussions that have been had, there's no doubt that they're considering and thinking about going in that direction. Whether or not they will pull the trigger, I don't know. I think we will ultimately get to some kind of a reset like that, but I think that's more likely to come after a period of very, very high inflation where everyone is screaming about the inflation. And then they can justify it. Then they can say, yeah, you're right. This inflation really is a problem. And here's how we're going to solve it. We're going to do a reset. Right. And to me, that's the most likely time frame. So that's part of why Trump wants to get rates down, run inflation hot, run the economy hot. Everyone's got a job, but inflation's cooking, and then right before he leaves office, because he's probably afraid he won't be reelected, they reset it. Right, to try and get things back under control. I don't know. It's just one thesis. So we got 251 million ounces of gold. So yeah, that's exactly right. $4,000 an ounce is $1 trillion into the TGA. It's really like the magic $1 trillion coin. I mean, it's mechanical. They just print the money and put it in the account. So, but if they want to make it hold at that level, as Groman has pointed out, and as I agree with him on, they would have to say, okay, we stand ready to buy and sell an ounce of gold at $20,000. Mm-hmm. You bring in $20,000, we'll give you an ounce of gold. And in turn, you bring in an ounce of gold, we'll give you $20,000. I mean, they would have to make a market in gold, literally. And then what they would see is, did they get inflows or did they get outflows? And what that would tell them is, is 20,000 the right number? Right? If it's $20,000 and everybody's giving them gold and getting the dollars, well, then they set it too high. But if it's the other way around, if everybody is saying, give me the gold, here's your $20,000, give me the gold, well, then they set it too low. Right. You can see that there's some real serious demand coming in out of China and Asia. I mean, those people, they love gold and they've been seriously demanding. In the U.S., the ETFs have been pretty dormant. There hadn't really been much demand. It's starting to pick up. You're seeing signs. I mean, Costco had gold bars for sale, and usually when they get them in, they sell them out pretty quickly. I mean, I think, I've had a lot more inquiries about friends. How do I buy gold and so forth? So, I would say that, we're starting to see a broader interest in gold, investment managers, et cetera. So, yeah, it's clearly coming, but it's not at the point where the shoeshine boy is recommending gold or gold stocks.
Lawrence Lepard's analysis paints a picture of the precious metals market standing on the verge of a significant breakout, not merely due to short-term price swings, but because the underlying forces driving gold and silver are converging in a way that has historically preceded powerful bull markets. Silver is now confirming gold's earlier move, signaling a broader, more forceful advance. While temporary corrections are inevitable, Lepard sees the long-term trajectory for both metals as decisively upward, with mining stocks poised to catch up after years of underperformance, creating a significant valuation gap that even modest institutional allocations could quickly close. On the monetary and geopolitical front, Lepard views a potential gold revaluation as increasingly plausible. U.S. vulnerabilities in manufacturing, defense supply chains, and access to critical minerals could prompt policymakers to actively support a set price for gold, most likely following a period of high inflation when public pressure for systemic change becomes overwhelming. Momentum in precious metals is no longer being carried by speculation alone. The tightening supply chain, steady demand from Asia, and the shifting stance of major banks suggest a structural turn rather than a passing rally. Silver's ability to mirror gold's strength, coupled with the possibility of a redefined role for gold in global finance, signals a market entering uncharted territory. What initially appeared as isolated price moves now seem like early signals of a broader transformation in how wealth and stability are measured. Could this convergence of technical strength and monetary pressure mark the point where precious metals transition from niche assets to the cornerstone of a new financial order? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.